Today we are going to look at national income accounting in an open economy, specifically at the balance of payments. Income in a closed economy, also known as autarky, where trade is not possible, is given by Y equals C plus I plus G, where C, I and G are consumption, investment and government spending respectively. Income in an open economy is the same as that in a closed, with the addition of exports minus imports, which is also known as the current account. Exports are goods sold to the rest of the world, while imports are goods bought from the rest of the world. If exports exceed imports, then there is a current account surplus, and if imports exceed exports, then there is a current account deficit. Countries such as the UK and US are running current account deficits, while Japan is an example of a country running a current account surplus. Let's move on to saving. National saving S is the proportion of output that is not devoted to private consumption C or public consumption G. S equals Y minus C minus G. A closed economy can save only by building its own capital stock, so S equals I. An open economy can save by building up its capital stock or by acquiring foreign wealth, so S equals I plus CA. An open economy's current account surplus is often referred to as net foreign investment because a country's savings can be borrowed by a second country to increase its stock of capital. There are two types of saving, private and government saving. Private saving is the part of disposable income that is saved instead of consumed, and this is given by SP equals income minus taxes minus consumption. Government saving SG is equal to taxes minus government spending. National saving S is the sum of these two types of saving, and so is equal to Y minus C minus G. From our equation for income in an open economy, this is equal to I plus CA. The balance of payments records all transactions between a country and the rest of the world during a time period. Three types of transactions are recorded: the current account, which is made up of transactions that involve goods and services, for example the UK exporting jeans to France. Next, there is the financial account, which is made up of transactions that involve financial assets, i.e. any form in which wealth can be held, for example money in factories. Finally, there is the capital account, which is made up of transfers of wealth between countries, for example copyrights. The financial account can be split further into the non-reserve financial account and official reserves. The non-reserve financial account is made up of private transactions, i.e. those done by non-central banks, while official reserves are made up of central bank transactions. One key thing to remember is that every transaction enters the balance of payments twice, once as a credit and once as a debit. Also remember that CA plus FA plus KA must equal 0. Now let's look at money supply in an open economy. The banking system consists of the central bank and commercial banks. Let's look at the balance sheets for both. So what assets are held by the central bank? Gold and foreign currency reserves indicated by FX, and LG, which is lending to the government. The central bank's liabilities consist of the monetary base, which is currency issued. Commercial bank's assets consist of MBB, which is currency plus deposits with the central bank, and L, which is loans. Their liabilities consist of deposits made by the public, which is D. Looking at the consolidated banking sector, assets and liabilities for both the central bank and commercial banks should be equal, so we have FX plus LG equals MB, and MBB plus L equals D. Summing these two equations together and grouping certain parts, we get FX plus LG plus L equals MB minus MBB plus D. LG plus L is the total consolidated banking sector's lending, also known as domestic credit DC. MB minus MBB is the total monetary base net of that part which is in the coffers of the banks themselves, i.e. currency in circulation, indicated by MBP. The right-hand side can be simplified further, since MBP plus D is total currency in circulation plus deposits in the banks, which is also known as the money stock MS. So we get that money supply is the sum of domestic credit and the value of reserves held by the central bank. So that's a quick summary of the balance of payments and what it involves.